Ever find yourself wondering if the market's about to continue or suddenly reverse? Is that breakout real or just another trap? Where's the real order block? And the big one, which direction is the market actually going today? These are some of the most common questions I hear from traders every day. And the truth is, there is a way to find clarity. In this video, I'm going to introduce you to a powerful concept called dealing range theory, or DRT. This framework will help you read the market with more confidence, recognize high probability zones, and stop second-guessing your trades. If you're serious about leveling up your trading game, you're going to want to pay attention. Let's get into it. So, the first thing we need to focus on is what exactly is a dealing range, and how does it form? ICT dealing range is simply a price range between swing low and swing high. Within the range, institutions are focused on accumulation and distributions campaigns. They use these ranges to manipulate retail traders. They manipulate price action, drive liquidity hunts, and influence major price movements. There are two primary types of dealing ranges: a bearish dealing range, where price sweeps an old high and then an old low, and a bullish dealing range, where price sweeps an old low and then an old high. These patterns typically form in trending markets and will focus on bearish conditions first. In this example, notice how we start with a clear swing high and a swing low beneath the market. To understand how a swing point is formed, take the swing high as an example. We require a three-candle formation where the middle candle has a higher high compared to both its immediate left and right candles. This pattern is what we refer to as a three-bar swing high. Similarly, a swing low is formed when the central candle is lower than the candles on both sides of it. This becomes a three-bar swing low. But here's the important part: look at how this price leg actually develops. From a higher time frame perspective, suppose the market is moving lower, possibly targeting liquidity below key lows, relative equal lows, or imbalances such as fair value gaps that the market needs to rebalance. In such conditions, the price often pushes higher first, executing a move that seems counter to the trend. This is part of the algorithm's function to shake out profitable traders and activate stop orders through manipulation. For example, many retail stop-loss orders tend to cluster above recent swing highs, so the price may push upward, tapping into buy-side liquidity above these highs. Once this liquidity raid occurs, we can begin to anticipate the formation of a dealing range. However, there's a crucial step to wait for. The market needs to move back down and breach an old swing low. This clears sell-side liquidity as well, essentially sweeping both ends of the range. At this point, we look for another three-bar swing low to print, confirming a significant low in the new structure. With both a new swing high and swing low in place, we officially have the parameters of a dealing range. This structure becomes a frame of reference for future price action. To analyze this structure, we can divide the range into quadrants using a Fibonacci retracement tool. The high of the dealing range becomes the 0 level. The low of the dealing range becomes the 1 level. The midpoint, 50%, is labeled 0.5, which we refer to as the 50 DRT level. Other key levels include the 25 DRT and 75 DRT marks. These DRT levels are more than just percentages, they are reference zones where high probability reactions often occur. The algorithm sees these levels as important markers and tends to build price delivery arrays around them. Understanding the division of the range is crucial. Any price movement above the 50 DRT level is considered to be in a premium zone. Anything below the 50 DRT falls into the discount zone. In bearish conditions, we want to look for shorts when price trades into a premium, that is, above the 50% line. If you're still getting used to these concepts, one practical approach is to wait until price reaches above the 50 DRT level, then start looking for signs of imbalance, such as a fair value gap, or any price delivery reference to the left of the chart. That's where setups often unfold. However, it's important to note that the market doesn't always retrace fully to the premium zone. There are scenarios where price may only reach the 75 DRT level, closer to the upper quadrant, before it reverses lower. In some cases, the market may only push up to the 25 DRT level, encounter resistance around that area, and then resume its move downward. This sort of behavior tends to show up when price fails to move above the 50 DRT line during a retracement. Instead of forming swing highs above the midpoint, the market sets a temporary high within the discount range, and eventually revisits the dealing range low. Now, let's break this down with a real chart. In this particular example, price first takes out a previous swing high, and then drops beneath a short-term low. This action effectively sets up a new dealing range, giving us the necessary high and low to draw our DRT quadrants. Using these reference points, we can divide the structure and begin applying our range-based framework. Let's consider a bullish scenario. If we're expecting prices to move higher, we typically want to see the market dip first, ideally breaking below a previous short-term low to the left. After that, we're looking for the market to reverse and move back up, surpassing a recent swing high. This movement helps establish a new dealing range, clearly marking both the high and the low of the range. Once this range is defined, we can analyze it and determine our DRT levels accordingly. In bullish setups, the Fibonacci tool settings remain the same, but we flip the orientation. The low becomes the 0 level. The high becomes the 1 level. In our current bullish scenario, we are looking for signs that the market is ready to push higher. That starts with price dropping below a known low or imbalance, and then we look for the first break of structure to the upside. Often, you'll see several highs form, but price doesn't manage to move above them. These are failed attempts. When the first meaningful break finally occurs, where a previous short-term high is actually breached, that's a strong signal. It marks the beginning of a new bullish dealing range and provides a fresh set of reference levels for us to work with. Let's go to the chart. At this example, we've cleared buy-side liquidity by breaking above a swing high, and also taken out sell-side liquidity to the left through a swing low. This gives us all the ingredients for a new valid bearish dealing range. So once again, we define the range from the newly formed high down to the low, and ideally, we want price to retrace above the 50 DRT. We see an FVG above the 50 DRT, and once price reaches this area, it presents a high probability opportunity to enter a short trade. DRT levels are very helpful for making optimal entries and avoiding liquidity traps. I hope this video has been helpful.